Hello and welcome to Class 8 Personal Finance. My name is Garrett O'Hara, and let's talk about emerging markets. The name gets thrown around a bit. I think it's getting thrown around quite a lot more, especially in the last 3 months or so. So let's get an overview of what emerging markets are, how to figure out whether they're in your portfolio, and what you ought to be doing about it. Should you have them there in the first place? Should you just be accepting market cap weights just the way the market invests in emerging markets, or should you be doing something else? Preview, I do something else. I really do. But my strategy is sort of insane, so you may not want to go with what I do. But let's get started. Emerging markets. What's an emerging market? According to the Wikipedia entry, honestly, this is the better entry than the Investopedia definition. An emerging market is a market that has some characteristics of a developed market, but does not fully meet its standards. This includes markets that may become developed markets in the future or were in the past. The term frontier market is used for developing countries with smaller, riskier, or more illiquid capital markets than emerging. As of 2006, the economies of China and India are considered to be the largest emerging markets. Okay, so an emerging market is somewhere below developed markets. Developed markets, obviously the United States, UK, Germany, France, Japan, Australia. And then you have emerging markets as a category below that. Country markets such as China, India, Brazil, Taiwan. Even Taiwan is considered an emerging market, and some of you might be wincing at that one. And there are some countries where the status of whether they are a developed or emerging market are actually in dispute. South Korea is the big one. One index provider says that South Korea is an emerging market. One of the other big ones says, nope, they're a developed market. So how do you sort all these things out? I'll go off and say emerging market is a bit of a misnomer. In fact, there's a portion of the Wikipedia article where it says the term is misleading, according to whom, in that there is no guarantee that a country will move from less developed to more developed, although that is the general trend in the world. Russia. Countries can also move from more developed to less developed. And yeah, Russia was an emerging market country until Putin decided to sneeze. And now they are a standalone market. They're not even a frontier market. They're just kind of off on their own, not an emerging market. So that kind of outlines the risk that you're taking with the emerging markets is you're talking about less developed countries, and you're talking about, in a lot of cases, less political freedom, less economic freedom, and there's risk that comes with that. And are you being compensated for that risk? That's an open question. Actually, there's an answer to that question according to some. We'll talk about it if I get there. But let's talk about country classifications for a sec. I've gone through this before. Pop-ups. Okay, so here's MSCI. They were one of the big index providers. Chances are, if you're invested in index funds, there's a good chance that you're invested with this. I'm going to hide my face for a moment because it's, tell you what, over here, there we go. How's that? All right. So you have your developed markets here, like Canada and the United States. You have the Europe and Middle East, Austria, Finland, Israel. That's kind of the Middle East one there. United Kingdom, Switzerland, etc. You have Pacific developed markets, Australia. Hong Kong is there. It's still there for now with the political things going on. So the economic freedom is still such that the index providers are saying Hong Kong is still a developed market. Japan, New Zealand, Singapore there. Then you have these emerging markets. So you have some names that you expect. China, India, Brazil, Chile, Indonesia. Korea is kind of the oddball here. Poland is an oddball as well. I think Footsie, and we'll check this in a moment, Footsie considers Poland to be a developed market. But we keep going here. Then you have frontier markets where they're just really hard to access, and I only know of one fund that really goes into frontier markets, at least for ETF and mutual fund investors. There might be some more that I'm not aware of, but it just doesn't factor in. It's not really worth your time to dig into, I don't think. Then you have these standalone markets where they don't even classify as frontiers, kind of on their own. And the hope is that eventually they move up. You can see Russia has now moved into there. Ukraine was already there. That's not a recent development. Ukraine would certainly like to get up to emerging status at least, but that's not going to happen in the current state of the world. Let's bring this back over here. And then we look at, this is Footsie Russell's website. This is another index provider that competes with MSCI. And they put out these bulletins every 6 months about their country classifications. I know this says annual right here, but there's also an interim one that comes out every March. So you can see Vietnam, there's a possible reclassification from frontier to secondary emerging. So they're trying to push up into that status. And then you go down here and you have these country classifications here. So developed is all in one column. They don't separate it out by geography. And so the US is there. Canada is there. The UK is there. I'm looking for France, Germany, Japan, etc. Developed markets. Footsie Russell also has this nice thing where they split out the emerging markets countries into 2 categories, advanced and secondary. So you can see Taiwan right there. They're trying to push up into developed. China is still down there under secondary emerging. And I will note here is that they actually, MSCI does this too, is they have a set of criteria that countries have to meet in order to pass muster as a developed market, or even going into an emerging market, for example. So you see all these red categories right here. It's not just, kind of looking at a country kind of go, are they developed? I don't know. Look at nice buildings. No, there's actually, there are actually criteria in their markets, like where the things get traded, where the securities get traded. And you can see for Taiwan right here, they're under advanced emerging alongside Malaysia and Thailand. This is just the Asia Pacific section, by the way, so you're not going to see some others here. And it says right here, Taiwan is not met under account structure operating at the custodian level, securities and cash. I'm not quite sure what that means, but I think they know what they're doing. So, maybe these guys will make it into developed markets status at some point. But even if Taiwan gets rid of this red, note that Malaysia and Thailand are still advanced emerging markets. Even though they have no red, they still have some restricted classifications all in yellow right here. So maybe someday Malaysia, Taiwan, and Thailand will all get up there in developed markets status. That would be good to see because it would be economically beneficial for the people who live there. Now, what are you going to do about this? Should you invest in emerging markets? How is this going to look? First off, let's think about the current status of your investments. Like, do you have emerging markets in there in the first place? For example, if you're in the Thrift savings plan like I am, this is the 401k type plan for federal government employees. I'm no longer a federal government employee, but I still have my accounts with these folks. You have this iFund here, International Stock Index Investment Fund. Nobody calls it that. It's iFund. It stands for international. And you can see right here, and I've gone through this on the channel multiple times, but I'll review it. The iFund's investment objective is to match the performance of the MSCI EFI, that stands for Europe, Australasia, Far East Index. What they don't tell you right here, but pretty much everyone who owns this fund needs to know, is that this is a developed markets index fund. Well, rather, this EFI index is a developed markets index. And therefore, when you invest in this fund, you are not buying emerging markets. You're not buying Taiwan. You're not buying even Korea. You're not buying China, India, Brazil, etc. I wonder if you could see this under composition. Yeah. So sort this by percentage of holdings. That's a nice upgrade right there. So you can see right here, Japan is number 1, UK number 2, France, Switzerland, Germany, and we're going down all these developed markets, and there's some countries missing. Oh, by the way, Canada is missing as well because Canada is not in Europe, Australasia, or the Far East. So you kind of wonder why they didn't pick a different index like the MSCI Developed Markets Index, and then you can invest in Canada in your TSP without going through the mutual fund window thing. If you are a fellow employee of a shipping company that has brown trucks, both 18-wheelers and delivery vans that for some reason we call package cars, and thinking that we might be going on strike come August of next year. If you're a fellow employee of that company, which I do not represent on this channel, your 401k also follows this index, the MSCI EV index. You are not investing in Canada or China, India, Brazil, etc. in your 401k. I know that for sure because I'm in it. So should you worry about that or not? If you want to do something about it, what do you do? One more example fund. Let's say that your 401k is with Vanguard. This is Vanguard's total international stock ETF. There's also a mutual fund version right here that's basically the same thing. In fact, they're share classes of the same fund. This does include emerging markets. You scroll down to this page here, and you can see emerging markets as defined by Vanguard comprise 26.8% of the portfolio. Now, VXUS, Vanguard, follows the Footsie Russell index, and so they don't consider South Korea, for example, to be an emerging market. So it kind of throws the number off. You can think of emerging markets that it's about 25% of the market that exists outside the US. So you scroll down here, look at the holdings. You can see from the holdings, if you know what you're looking at, right away whether China is in there. You see Taiwan is there. That's an emerging market by all definitions. And so it's actually the largest. Taiwan Semiconductor Manufacturing Company. That's the largest holding in here now. It used to be Nestle. Taiwan Semiconductor actually just made the overtake there. But you can see Tencent right there. We used to see Alibaba up here. And I guess they haven't been doing well as of late. Mr. Xi over there in China isn't being very nice to them, I guess. Then we can look at markets right here. And you can see Japan is number 1, UK number 2, China number 3 at 8.7%. That's 8.7. That's of the entire world, by the way, outside the US. 8.7%, Canada 7.8%. So that makes you kind of think, if you're in one of these MSCI EV funds, should you be holding a separate Canada fund for one, because you're missing out on 7.8% of everything else that's out there over in Canada. But also, should you be thinking about, patching up your portfolio because you're missing out on 26.8% of the markets that are outside the US? Is this something you should worry about? Well, let me look at one thing. I didn't pull up this. Let me talk about market cap emerging markets funds first. I'm trying to go off my notes and try to keep things according to the plan. So you could use a fund like this one. The thing about what I was talking about with these country classifications is you, as much as possible, you don't want to mix index providers as long as you're sticking with plain old index funds. So if you are in, for example, the Thrift Savings Plan or that Brown Shipping Company Union 401k plan, then you should use MSCI emerging markets funds if you're going to go with index funds to patch things up with emerging markets. So you have this fund here, IEMG, which has a very nice expense ratio, 0.09%. And take a look at it. So you come down here to the holdings. You can see Taiwan right there. Taiwan Semiconductor Manufacturing being number 1. Samsung Electronics number 2. Tencent is up there. Alibaba is up there. That's as of October 21st. So I wonder what happened with the other fund. Was that VXUS we were looking at? You know, it's because with the developed markets kind of diluted that. That's what's going on. See Alibaba right there? It's because this includes developed and emerging markets. That's why. So let's go back here. Stop getting distracted. All right. And then go to exposures up here. Where'd it go? You're embarrassing me. There we go. So under exposure breakdowns, when you go to the page for the first time, you're going to have to click from sector onto geography here. And you can see China is 26.29% of this emerging markets fund. So you think about this in theory and you kind of go, okay, if emerging markets are about 25% of the world, we can find a more accurate figure for that, by the way, just by going to, let me see if this works. I'm trying to think of the fund though. You know, I'm not going to worry about it right now. Let's just say emerging markets are like 25% of the world. Then you could say, okay, I'm going to go grab this emerging markets fund, this one, and say I'm going to make this 25% of my international allocation, and you just kind of work this out in a spreadsheet. That's something that you could do. Now, there's a question kind of hanging over us right now, especially if you pay attention to politics, and that is that China question right there. And this has been, hey, I get a little nice animation out of that. And that has been China's heavy hand on the market on top of human rights violations, and the human rights violations have been the case for years. It's not a new thing. And so do you want to be invested in China in the first place? I've talked about this before on the channel, and my answer to this is no, I don't want to be invested in China, but I still want to be involved in some emerging markets. So how do you kind of work this out? Because if you go with a fund like this one, you're going to have China. Vanguard has its own version as well. The ETF ticker is VWO. And so you could pair that with a Vanguard developed markets index fund and go that way. But or the other thing is, what if your 401k or your 401k only has a fund that does have China, and you kind of go, okay, I want international exposure, but I don't want the China one in there. I should have brought this one up earlier. Let me talk about that scenario first. If you plug in VEA here, Vanguard, what have you done to me? Okay. Vanguard. Okay. So is this one right here? I would say this is the most complete straight index fund in terms of developed markets only. Vanguard Footsie developed markets ETF. And so the countries that are in this ETF are going to be the ones that we just talked about in this left column from the Footsie website, Australia all the way down to USA here. And that's going to end up ignoring everything else over to the right. And then you have to think about, okay, how do I patch this up with more emerging markets? If you already have an international fund in your 401k and you like that international fund, and you have a problem with putting China in there, like, okay, I want emerging markets, but you don't want the China part in there, what do you do? Let me backtrack here and say, okay, yeah, it is good to invest in some of these emerging markets. Let's talk about the freedom aspect for a moment. And there's a link I want to pull up here. Let me see if I can move it over. I feel like I'm a little disorganized here today, so I might ask for your patience. This is a article from Larry Swedroe that came out 2 months ago. It's called "Is Democracy Good for Stock Market Returns?" I just started browsing through this. I haven't read the whole thing, but I got the point out of it, because when you talk about the risks that are in emerging markets, I've talked about risk before on this channel. And the thing about risk is that if it's a compensated risk, for example, value stocks, small stocks, that kind of thing, then what risk implies is that there should be a positive return associated with that risk. If you're going to take more risk on a investment and it's a compensated risk, it's a diversified risk, then there should be more expected return out of that, unless that risk shows up. That's why it's risky, and so that's why you should expect a higher return. There should be more compensation associated with an investor taking that kind of risk. But there are uncompensated risks. And so the question is, if you're going into emerging markets where human rights protections and democracy just aren't as strong, is there a positive return expected with taking on that particular type of risk? Here's the answer. There is a positive relationship between democracy levels and stock returns, a negative correlation between democracy levels and volatility, and a negative correlation between stock returns and lack of political rights compared with democracies. Autocratic states were characterized by lower returns despite exhibiting higher return volatility. And there's another piece of this, and was it in the takeaways? Because stock investments in more autocratic countries have provided lower returns with higher volatility and have been accompanied by expropriation risk. That's basically the country coming in and saying, hey, that's ours. That's no longer yours anymore. And that actually just happened to ExxonMobil in Russia, by the way. Investors should underweight these countries in their portfolios. Investors wishing to minimize expropriation risk should consider screening out autocracies from their portfolios, or at least minimize exposure to them. And some risks are just not worth taking, no matter the risk premium. Expropriation risk might be one of them. So with that in mind, I would say, here's my opinion and my advice. I don't provide advice. My thought here is not that orthodox, because the Boglehead market cap weight orthodoxy is basically, invest in every country in the world and try to be blind about it. My thought here is, okay, you really should try to avoid these autocracies. So how do you go about that? There are some weird funds out there. So let's start getting weird here with some of these funds. For example, here's iShares again, but they have an MSCI Emerging Markets X China ETF. X means excluding. If I forget to say excluding for the rest of the video, when I say X, it means excluding. So you can kind of go down here to, well, let's go to the holdings right here. Taiwan Semiconductor, Samsung Electronics, Reliance Industries. See what's missing? Tencent, Alibaba, etc. But hey, Saudi National Bank. Okay, do you feel safe in Saudi Arabia? That's not a democracy. India, Taiwan, South Korea, Brazil, Saudi Arabia, South Africa. And so obviously China's missing. China was some 25% of the other iShares fund. And some of you are kind of scratching your heads, maybe kind of judging me, because we've just been talking about China risk. And if you're familiar with right-wing political social media right now, BlackRock is a really unpopular company right now. BlackRock is like, okay, the image of Larry Fink, the CEO, being Big Brother staring down an auditorium with, blue light before the Apple commercial throws a hammer at him or something like that. That's not how it went, is it? So those of you who are avoiding China in part because of your right-wing politics, and I'll admit, okay, my avoidance of China is not entirely, I'm like totally rational and just mathematical. Okay, I want to avoid China too, for social reasons. I'm just going to, be honest with that. A lot of you are going to want to avoid BlackRock because of Larry Fink and the political associations that BlackRock has in pushing companies in a woke direction. I'll just go ahead and say woke there. That's what the criticism is. There is another X China Emerging Markets Fund. So this is EMXC, Emerging Markets X China. And so the other one is really easy to remember. It's XCEM, X China Emerging Markets. This put up by another company called Columbia Threadneedle. I don't think I've ever had any of their ETFs, so I've never had this one. I have had that iShares one, EMXC. I haven't had this one. The expense ratio is actually a lot cheaper, 0.16. It's not as cheap as that IEMG, the straight up emerging markets fund, with China in it, but 0.16 is pretty good. I haven't researched big into the bid-ask spread, but as long as you're not trading too much, I wouldn't worry too much about bid-ask spread, I don't think. What is the AUM on here, if I can find it quickly? Let's see, AUM. Fine. Assets. Row assets. Net assets. It's not going to tell me the assets under management? Okay. The reason I'm looking for the amount in assets under management is that tends to be a good indicator of what the bid-ask spreads should be, like what the difference is between the bid price and the ask price when you buy the ETF. But it's not even showing up here. That's weird. And I'm not going to dig that far. I don't want to go on a sidetrack too much. So there's weird funds like these two that are emerging markets X China. Now, since you might be familiar with the right-wing politics and the concerns about BlackRock going woke, the one guy in the media who's the most visible about it is this guy. This guy's name is Vivek Ramaswamy. He wrote a book a while back called Woke Inc. INC period Inc. I've listened through it twice on audiobook, and I agree with like 80% of it. His firm, Strive Asset Management, now has an S&P 500 ETF out there with a pretty cheap expense ratio. Not as cheap as the Vanguards and BlackRocks, but pretty cheap. And then they are coming out later with an emerging markets ex-China ETF. So maybe that's something to consider as well if that makes you feel better about it. So China's not the only autocracy. Saudi Arabia is also an autocracy, etc. So that fund, that Strive fund, is going to look very similar to this. So do you want to go farther than this? Maybe you do. Let's go with more weird funds here. This right here is the Freedom 100 Emerging Markets ETF, FRDM. Great ticker. I used to be in this one. I mentioned it in the channel back when I was talking about how not all emerging markets funds are the same, but I didn't focus in on emerging markets as much in that one. I'm also no longer invested in this one, and I'll show you why. I'll talk about how this is formed for a moment. So it starts with these 27 country emerging markets universe. It's going off the MSCI classifications for that, by the way. They screen out countries with not enough market cap, so just not enough assets in them to be investable. And then they weight the countries by freedom using third-party measures. They say here, Fraser Institute, Cato Institute, basically to measure the level of freedom in those countries. So you're talking about how we saw in that article that democracy is associated with better investment returns in these countries. This is a way to do that systematically. They exclude state-owned enterprises. Companies with 20% or more state ownership are excluded. And finally, they have a final security selection. So it's called Freedom 100 because originally there were 10 countries in it, and they would take the top 10 stocks in those countries and develop a 100 stock index. But you'll see right here that there are actually 112 holdings, and the reason is this list is the top 10 country holdings. I looked it up on Morningstar, and Philippines also made it in. So it's actually 11 countries times 10 stocks, and then probably 1 or 2 holdings are like cash and some other liquidity thing. So you're talking about 11 countries times 10 stocks for each of those countries. Here's what freaked me out. Chile. Not that I'm against the Chileans by any stretch. And in fact, we owe the Chileans a bit because I live in Texas, and we Texans on social media are so bad. You look up, you go to Twitter, and you type in the word Texas, and you add the Chilean emoji, the Chilean flag emoji in there, and it is just awful. Like, the Chilean flag is not the Texas flag. Stop it. Stop it, my fellow Texas residents. Just don't do that. Don't. Okay. But besides that, Chile recently had a presidential election. They elected a socialist who's about my age, maybe a little less. I'm 37. Yeah. So I don't think the country economically is going to be going in a good direction. They recently rejected a major constitutional overhaul, which might be a good thing, but and even if the political thing isn't a thing for you, note the weights. So these weights are based on the third-party freedom measures. So what this is basically saying is, hey, Chile is freer than Taiwan, freer than South Korea, freer than Poland, freer than Brazil. I definitely, believe when they say they're freer than Brazil. Now, here's the thing. You got to compare that with market capitalization. Like, how much overweight Chile do you have here? Well, that's easy to figure out if you look at the country weights by another measure. So let's go back to here and find, where's Chile? This is the emerging markets ETF from iShares. Chile is so small, it doesn't even make it onto the list. It's like under the other. It's somewhere below 3.65. If you look at, just to kind of get a rough measure, I'm going to use Morningstar. Let's see. Let me see if Morningstar is going to tell us. IEMG. Check. My microphone still works. Yay. Unfortunately, Morningstar tends to load slowly when I'm recording videos because of having to write down the file and then do all this other stuff at the same time. And these animated ads don't help either. You can come down here to exposure and then go to country right here. Let's see if we can find Chile. There's Chile. Chile, according to this, is 0.59% of the emerging markets. Now, that's not even 0.59% of the market outside the US. That's 0.59% of emerging markets. It's going to be even less for that. But this is basically the objective measure. 0.59%, but FRDM says Chile is 25.47% of the entire emerging markets portfolio. That spooked me out, and that's why I left FRDM. I couldn't stick with that. You might be looking at the expense ratio and saying that's pretty high. I think that's an okay expense ratio for what they're doing because it's a fundamentally unique thing compared to IEMG, the IEMGs of the world. But between having only 10 stocks for each of these countries, maybe or maybe not, that may or may not be a huge thing. But being this overweight based on the freedom rankings, I couldn't stand by that. So this is where things get really weird because I'm going to be talking about my own portfolio. So let me show you this. This is my actual portfolio, at least in stocks. And sometimes people will talk about the 3-fund portfolio, the 4-fund portfolio, the 5-fund portfolio. Well, I've got a lot of asset classes here. One of them shows, a couple of these show 0 right here. I was thinking about India, and then I decided against it. And then this right here, international developed markets, is basically trying to work out things between different accounts. You can see that I have Canada right here is a separate asset class because the EFI index doesn't include Canada. And then you see I have all these different countries that I've decided are investable. And yes, I have Chile there, but note it's 0.08% of my overall portfolio and not 25% of my emerging markets, which would still be some much larger percentage than 0.08. This is a really pedantic portfolio. Not everybody's going to want to do this. Okay, I'm back. So you have these countries right here. Now, how do you invest in all these individual countries? Well, you find individual country ETFs. And a word of warning, if you actually go about this, which you probably shouldn't, make sure you know what the ETF tickers are, because I accidentally bought the India ETF when I was intending to buy Indonesia. So you can see that I have basically two index fund providers for these individual country funds. One of them is iShares, and the other is Franklin Templeton. Oddly enough, I've talked about Franklin Templeton on this channel before, and I was very negative about them, but these were cheap index funds for investing in these individual countries. And I'll highlight a couple of these to kind of show what the differences are and why I have them different like this. So, for example, for Taiwan, the iShares offering is EWT. So I'm just going to search for EWT ETF and pull this up here. That's the wrong one. Let's go back. There we go. iShares. I should have pulled this up before. So iShares MSCI Taiwan ETF. Expense ratio 0.57%. Kind of feels pretty steep. Scroll down here, check the holdings, and indeed, Taiwan Semiconductor Manufacturing, 20%. Plus a lot of other countries here. And note, unlike that FRDM ETF, there are 94 holdings going all the way down here, and only one of those. See, two of those are liquidity related, and then it goes up from there with all these different Taiwanese stocks. The pedantic Garrett likes that. I want as many stocks in there as possible. I want diversification among my Taiwanese stocks. Now, the other fund provider is Franklin Templeton, and this one is FLTW. I don't want any of those. I want the horse's mouth. Back button, United States. Don't you love it when these ETF providers don't have the proper title tag in their HTML? Franklin Footsie Taiwan ETF. Year-to-date total return, negative 37%. Yes. But note that the expense ratio here is 0.19%. Now, I was talking about bid-ask spreads earlier, and yeah, the bid-ask spreads on this fund are going to be higher, but I think paying that bid-ask spread is worth it to have that expense ratio as long as you're a long-term investor in these ETFs. So when you are searching for these, if you are insane enough to pursue this strategy, you can just search for Taiwan ETF, for example, and look for etfdb.com because you're going to have lists, and let's get this to pull up. This is not what I want. There we go. So you'll end up with lists like this one, and then you can see, one, whether there is more than one fund for that particular country, And if there are, you can sort here by expenses and then see, hey, this one has a lower expense ratio than this one. And that's almost all you really need to know, unless it just doesn't have enough assets to be liquid. Then you should be able to feel pretty safe just going with a lower expense ratio. And so that's basically what I did with all of these funds. So anywhere you see an iShares ETF here, it's because Franklin Templeton didn't have a single country ETF for that country. But wherever you see Franklin here, Franklin is really offering the lower expense ratios across the board for these countries. And so I went with those. And so now the question becomes, how do you decide the percentages for each of these countries? Because note, I've got all these different percentages here. You could look at VXUS. If you're going by percentage of your international allocation, you could use VXUS as your index. So for example, Chile right here, I have highlighted at 0.20%. And so going here, Chile actually is 0.20% of my whole international. The percentages you're looking at here are actually percentages of the whole portfolio on the stock side. If I were to type in VT right here, that's the total world stock index. I'm not going to do that right now, but then you could see those things line up. And then you could also mess with the percentages a bit if you want to put more into particular countries, which is actually what I did with South Korea. South Korea is not 2% of the entire world stock market, but they have a really nice valuation right now. I'm not going to go too much into that at the moment because the video's been long enough already. And oh, by the way, Taiwan's in the news a lot about whether they're going to be able to defend themselves from China. I think if China does invade Taiwan, it's going to it's going to affect the entire world market if it does that. So, I mean, yes, I am underweight Taiwan. I'm not completely out of Taiwan, but don't feel like, oh, if I just divest from Taiwan and China invades, nothing's going to happen to me. It's going to affect everything. If China actually does that, and I don't trust Mr. Xi. I've literally been in the Taiwan Strait. I don't trust Mr. Xi, Navy veteran. That's why. All right, so that's the video. The emerging markets, do you need them? If you are looking for a simpler portfolio, you want to live in 401k world, and your 401k does not have emerging markets, no, it's not essential to go outside and go into Roth IRA world to pick up an emerging markets fund. But if you are seeking complexity, if you find this stuff interesting, and you know that day trading and trying to pick individual stocks is just not a rational thing, you understand that it really is taking on irrational bets and too much idiosyncratic risk, but you're interested in investing and you like working with these kinds of numbers, definitely consider at least an ex-China emerging markets fund. Consider FRDM maybe, although the Chile issue still is a thing. Or if you want to get super complex, you could go with individual country ETFs as long as you are proficient with the spreadsheet. And what I'm not going to do is like provide a spreadsheet to you, kind of go here, just use this, and then you get confused. Really, when you're going to use a spreadsheet like that, you need to be able to construct it yourself and figure out how much you need in there, looking at the portfolio as a whole. And I just don't think that's going to be even close to the majority of the people who use this channel. But I'm putting it out there for educational purposes. So like I said here, do as I say, not as I do. No, seriously. It sounds high and mighty to say. I mean, I heard Dave Ramsey say this on the radio a few weeks ago. I don't ask you to do anything that I don't do, or I don't do anything that I don't ask you to do anything that I don't do. Okay, right, but you're not Dave Ramsey. You're not in his situation. Personal finance is personal. So this portfolio This idea of going into every single country that you want to be in might not be for you. It really might not. You might just want to stick with developed markets and then cruise along. But that's emerging markets. I don't advocate just going in blindly and say, hey, have a emerging markets fund that's 26% China. This used to be 40% China. By the way, the reason why it's less now is because the Chinese market has really, really gone down. And I'm glad I got out of standard emerging markets investing when I did, because that saved me quite a lot of money. Okay, I'm concluding the video. Have a nice day. Happy investing. And I'll see you in the next one.